And let's look. Okay. Okay. Okay, I'm gonna read a few articles from Yahoo Finance first, and then I'll go over to the one that I love to read, like themotleyfool.com and marketbeat.com. First, let's see this article first. First signs of recession pain look set to emerge from earnings. Okay, just as investors are celebrating the prospect of peak inflation and potential for a soft landing, um, this earnings season is likely to show there's still plenty that should keep them up at night. Okay. Hmm. With coastal on the rise, interest rates starting to bite, and consumer spending declining, research is expected to reveal the start of a U.S. earnings recession, which will last until the second half of 2023. So recession will still last. Okay. According to Bloomberg Intelligence Strategies, while analysts have been busy slashing their forecast over the past few weeks, the consensus for corporate profits in 2023 remains materially too high. Okay, with or without an economic recession, according to Morgan Stanley's Michael Wilson, who warns that stocks can fall about 25% in the first quarter under pressure from poor earnings and guidance. Okay. Madison Fowler Global Strategies at JP Morgan Private Bank expects management to provide cautious commentaries given rising recession risk, higher than normal inventories and wage pressures. With developed economies slowing, we think strict estimates will likely continue to move lower, but not collapse immediately, Fowler said. Okay, margin degradation will likely continue into 2023 and will be the focus in management discussions with investors. Okay. Things that are about to happen and things are about to mm, recession related events. Hmm. A lot of companies have become too big for the shrinking economy and the more difficult regulatory environment, and they are indeed in greater need for right sizing, said Marita Vaymin, a senior strategist at State Street Global Markets, who stresses the importance of looking at earnings guidance, which is likely to be a lot more negative than currently reflected in consensus estimates. Okay. Huh. Well, let's go over to this one. Okay. Take Warren Buffett's advice, buy stocks with these three attributes. Okay. Two growth stocks down more than 30% to buy right now. Three Roku stock prediction for 2023. Two ultra high growth stocks are on sale now. Okay. The S&P 500 just had one of its worst years in history. Here's what usually happens next. Two FANG stocks the smartest investors are buying hand over fist in the bear market. Um, should you buy the 55 highest paying dividend stocks in the S&P 500? After strong earnings report, is Bank of America buying now? Okay, why I plan to wait? Okay, let's see. Okay. Take Warren Buffett's advice, buy stocks with these three attributes. A key way Buffett's company Berkshire Hathaway has beaten the market is through its large equities portfolio. Buffett picks stocks based on financial performance, valuation, and another key intangible. Okay. Warren Buffett's company Berkshire Hathaway has greatly outperformed the stock market since 1965. Yes. If you are an active investor, then you've likely heard the name Warren Buffett once or twice, given that he's one of the greatest investors of all time. His company Berkshire Hathaway has beaten the broader market handily since Buffett took over the firm in 1965. A big part of Berkshire's outperformance is thanks to its large equities portfolio, now valued at more than $322 billion, where Buffett and his investing team buy and sell individual stocks. When choosing individual stocks, retail investors can learn a lot from the Oracle of Omaha investing strategy. They should take Warren Buffett's advice and buy stocks with these three attributes: consistent outperformance. The first thing Buffett looks for is whether or not the company he is interested in has a solid track record when it comes to financial performance. Okay. One of the ways Buffett evaluate this is through return on shareholder equity, which is defined as net income divided by equity, and profit margins, which looks at how much of a company revenue becomes profit. So revenue becomes profit. Revenue becomes profit. Okay. Uh, Shareholders equity, which is defined as net income divided by equity, and profit margins, which looks at how much of a company's revenue becomes profit. Mm. The goal is not to find a company that can generate a strong ROE or profit margin once, but one that can do it over and over and through a variety of different economic environments. So one that generate profit once in a while, not that, but like the one that makes consistent profits like over and over. That's the one that he's interested in. Uh, Consistent performance is a key point at this point, right? Hmm. Defined as net income divided by equity and profit margins. Hmm. For instance, one of Berkshire Hathaway's largest holdings, the credit card and payments firm American Express, has generated above a 12% ROE for the last decade, and many times the ROE was 25% or above. Meanwhile, Apple, which is by far more Berkshire's largest holding in its portfolio, has had over a 20% profit margin since 2010. So let's look at it one more time. Shareholder equity, which is true return on shareholder equity. Net income divided by equity. And profit margins, which looks at how much of a company's revenue becomes profit. How much of a revenue becomes profit. Hmm. Okay, let's look at it one more time. One of the ways Buffett evaluates this through return on shareholders' equity, which is defined as net income divided by equity, and profit margins, which looks at how much of a company's revenue becomes profit. The goal is not to find a company that can generate strong ROE or profit margin once, but one that makes or in profit margins consistently. And so consistent performance is a key point at this point. American Express and like Apple. mm, Valuation. Buffett has been a great value investor over the years. He purchases stocks trading below their intrinsic value that the market has either ignored, perhaps doesn't understand, but that will trade up to up or above their intrinsic value over time. Now, there is a method to the madness, and Buffett and Berkshire do not simply look for stocks trading at bargain valuations. Method to the madness, Buffett and Berkshire do not simply look for stocks trading at bargain valuations. As Buffett once wrote in a letter to shareholders, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That means don't let valuation blind you. If something is traded at a huge discount to its book value, there's likely a good reason for the discount. Instead, it's a better idea to find a company that is great and that you can buy it at a fair valuation, which will serve you better long term. One example is Bank of America, the second largest holding in Berkshire's portfolio. Bank of America currently trades at about 160% of its tangible book value, which is hardly a discounted bank stock valuation, especially in today's market. But Bank of America is now the second largest bank by assets in the U.S. It's highly profitable and has developed a strong moat with its deposit and lending franchise long term. Buffett believes this is still a very fair valuation at which to own the stock. Okay. Impenetrable brand. Mm, Impenetrable brand. Another theme you will see among many of Berkshire's holdings is incredibly strong power brand power. So brand power is really important when he trades. Think Apple and Coca-Cola. Now, why does Buffett like strong brands? It's not because of the funny commercials. The real reason is that strong brands provide these companies with a tremendous amount of pricing power. This comes in handy in times of high inflation like the ones we're in today. Even though Apple's or Coca-Cola's cost of doing business has gone up, their strong brands also allows them to raise the prices of their products without too much pushback from consumers. Think about the iPhone and what a big part of people's lives it has become. If the price of an iPhone goes up $100, most consumers are still going to buy it anyway, especially if they've been with the brand for a while. And how many times have you heard somebody say they will never drink Pepsi over Coke? You know, even if Pepsi happens to be cheaper odds are that if a person has a choice between the two, they are still likely going to pick Coke. Companies with this kind of branding power can be great long-term stocks to own. So companies that have brand power. Okay. Impenetratable. Impenetratable brand. Impenetratable brand. Two growth stocks down more than 30% to buy right now. You've rarely been able to buy Alphabet stock at this valuation. The growth outlook for Microsoft's cloud business remains very promising. Okay. Mm-hmm. Headwinds are temporarily at Alphabet. Okay. Google parent Alphabet is down nearly 39% off its high, due mainly to the broader market declines. Additionally, several macroeconomic factors, including rising inflation, the war in Ukraine, and central banks tightening monetary policies, are causing marketers to reduce their spending on Alphabet's platforms. The short term nature of these headwinds and the company's excellent revenue and profit growth history lead me to believe the stock price decline is a buying opportunity for long term investors. Indeed, Alphabet grew revenue from $46 billion to $258 billion between 2012 and 2021. The company is home to Google and YouTube, two of the more dominant consumer platforms today. YouTube has 2.5 billion monthly active users that spend meaningful time viewing content. Google boasts an 84% market share of search engines worldwide. Hmm. The strong connection to consumers has allowed Alphabet to charge premium prices to marketers. They're looking to influence the purchasing decisions of those users. Hmm. Anyway, the point of here is that the bottom line is that um, Alphabet and Microsoft, the two are both a long-term buys. Alphabet and Microsoft both have strong competitive advantages and growth opportunities that make them fantastic long term investments. While neither company is likely to be completely immune to macroeconomic headwinds and other sources of volatility, each tech giant has what it needs to preserve through challenges and emerge ready to seize fresh opportunities and continue delivering strong returns for shareholders. Mm. Okay, next one was a three. The prediction about Roku. Okay, Roku. Mm. Three Roku stock predictions for 2023. Uh, Roku stock has been pummeled over the past year. However, nearly all the factors related to the economy predict a rebound in Roku stock price by year end. Mm. Okay. The streaming pioneer had an abysmal 2022. Will this year make market turnaround? For a time, it seemed Roku was invincible. At the height of its pandemic, its revenue had soared 548% since its late 2017 IPO, driving its stock up 1,940%. But Roku's lockdown-driven growth spur gave way to tough comps, slowing account growth, and the biggest stock market crash in more than a decade. As a result, the stock has plunged 90% from its peak. Once again, had soared 548% since its late 2017 IPO, driving its stock up 1,940%. But Roku's lockdown-driven growth spur gave way to tough comps, slowing account growth. Okay. Yet, despite all the bad news priced into the stock, there are reasons to believe the best is yet to come for the streaming video pioneer. Here are three predictions about what to expect from Roku in 2023. Roku account growth bounces back. Yeah. Like many companies in the streaming video business, Roku spent the 2022. Okay, like many companies, the streaming video business, Roku spent 2022 with a pandemic related headache. Viewers on lockdown in 2020 and 2021 accelerated the adoption of streaming, particularly during the early days of COVID. But reversion to the mean is unforgiving, and that massive full forward of business eventually gave way to nearly impossible to surmount year-over-year comps. That's not all COVID-19 outbreaks in China sending the supply of Roku-enabled devices and connected TVs into free fall, causing the company's accounting growth to slow to a crawl. Yeah, there is a powerful secular tailwind that will fuel Roku's future growth over the coming year. Viewers are abandoning cable TV in record numbers during the first three quarters of 2022, the most recent data available. There is a powerful secular tailwind that will fuel Roku's future growth over the coming year. Secular tailwind, okay. So people are abandoning cable TV, right? The major pay TV provider shed 4.6 million cable subscribers, according to information provided by Litchman Research Group. The trend is expected to continue with the total defections for a year expected to exceed the record-setting industry losses that occurred in 2020. Logic dictates that many of these cord-cutting viewers will turn to streaming video to meet their home entertainment needs, and Roku will be there to fill the void. Logic dictates that many of these cord-cutting viewers will turn to streaming video to meet their home entertainment needs. Mm. And Roku will be there to fill the void. Okay. Ad revenue rebounds. Okay. Mm, so people are abandoning cable TV, and people will turn to streaming video, uh, to have their entertainment needs, and it's going to fill their void. Uh, okay. Ad revenue rebounds. Some investors think of Roku in terms of its popular streaming devices, but that's not how the company makes most of its money. Its licenses use a Roku operating system, which powers a growing number of connected TVs. Mm. The company also gets a 30% split of the digital advertising on its platform, as well as 100% of the advertising that appears on the Roku channel. Mm. Its homegrown streaming offering. These profit drivers make up Roku's platform segment, which generates lion's share of its revenue. So they got OS operating system and ad advertisement. It's not only the device where they get profit, but like they sell OS and advertising, advertising on their platform. Hmm. Unfortunately, advertisers have been paring back spending or to shore up capital during an uncertain economy. As a result, Roku's platform segment grew revenue by just 15% year over year the third quarter. However, while that might seem dismal at first glance, viewing this in comparison with other digital advertisers help provide context. Mm. This shows the extent of the industry-wide marketing pullback driven by the faltering economy. The problem is not limited to Roku and the companies outperforming its peers. Hmm. One thing are back on solid ground. Advertising should come rolling back, bringing Roku along for the ride. So recently, with COVID around, advertising industry has not been doing well, and it's still not doing well currently. But it's going to rebound sooner or later, and Roku will and it will bring Roku along for the ride. Mm. So we'll see soon. So let's see. Let's briefly sum up. Ad revenue rebounds, and Roku account growth bounces back, mm. And profits return. Since the onset of the bear market, Roku has been racking up losses at a dizzying pace, but that wasn't always the case. In fact, turning back the clock to 2001 reveals the company had profits in each and every quarter as well as for the full year. Okay, profits return history shows that without the prevailing and persistent headwinds encountered in 2022, Roku has no problem turning a profit. That's why I predict its profitable ways will return at some point in 2023. So profits return. Okay. Hmm. Aforementioned advertising slowdown played a big part. So aforementioned advertising slowdown played a big part in overall mm, marketing companies and like the companies that use advertising as a revenue source, main source. Uh, Additionally, Roku chose to subsidize the cost of its namesake streaming devices rather than raise prices, even as inflation and supply chain disruptions sent the cost skyrocketing. Okay. Okay, next two high growth stocks are on sale now. Fig is putting up impressive numbers and sells at a big discount to top apparel brands. Coop is carving itself a lucrative position at the e-commerce leader in South Korea. Let's see. Coupon. Okay. Let's see what it says about Coupang. Okay, South Korea is the sixth largest e-commerce market in the world, and it's also one of the fastest growing. Coupang is stealing a page out of Amazon's playbook to build a major competitive advantage serving Korean customers. They spent years building over 40 million square feet of fulfillment capacity to expand its selection and shorten delivery times, and that's paying off. Revenue tripled between 2019 and 2021. And the company continued to report high growth in 2022. Coupang is delivering these results while also showing improvement in its bottom line. It reported a record profit in the last quarter. The company was also able to reduce its fresh food inventory losses by 50% with investment in machine learning. Mm, okay. Which have helped the company better predict customer spending patterns. Investment in automation and robotics to process orders should lead to growing profits over time. Coupang still has an enormous addressable market to go after. The Korean e-commerce market is expected to grow 10% per year to reach $291 billion by 2025. Coupang is also expanding into food delivery, entertainment, fintech, international expansion, which could create a lucrative flywheel of profitable services to augment less profitable retail sales. The stock was recently valued during the pandemic, trading as high as 24 times sales. At a price to sales ratio of 1.5 as of this writing, investors are undervaluing South Korea's largest e commerce player. Coupang, okay. Hmm. Well, okay, next. The S&P 500 just had one of its worst years in history. Here's what usually happens next. The benchmark S&P 500 fell 19.4% in 2022. It's the fourth worst decline since its inception in 1957. Okay. Since 1957, the S&P 500 has only fallen more sharply than 19.4% in the 3 years. 1974, 2002, and 2008. Each of those downturns was precipitated by major economic headwinds. In 1974, gasoline shortages and double-digit inflation rates caused the S&P 500 to plunge 29.7%. In 2002, the fallout from a frenzied investments in internet technology companies um, and the subsequent implosion of the dot-com bubble caused the S&P 500 to drop 23.4%. And in 2008, the collapse of the US housing market and the subsequent global financial crisis caused the S&P 500 to fall 38.5%. What happened next? In all three cases, the broad-based index staged a spectacular recovery in the year immediately following its meltdown. In fact, the S&P 500 produced an average return of 27.1% in 1975, 2003, and 2009. The details are provided in the chart below. There is another interesting fact buried in the data. Um, since its inception in 1957, there have only been two occasions in which the S&P 500 fell for two consecutive years. The index posted back-to-back declines in 1973 and 1974, and it fell 43 consecutive years between 2002. So what smartest thing investors can do right now? The best way to capitalize on the stock market downturn is to invest on a regular basis. On a regular, in the last 2 decades, more than 80% of the S&P 500 index best days occurred during a bear market or the first 2 months of a bull market. Last 2 decades, more than 80% of the S&P 500 index's best days occurred during a bear market. 80% of the S&P 500 index's best days occurred during a bear market. And missing even a few of those days can be a very costly mistake. Of course, not all beaten down stocks will regain their previous highs, but there are plenty of good businesses in growing industries like Shopify, e-commerce, Amazon, Tesla, and many are trading at heavily discounted prices. Okay. Hmm. Okay, let's see this one. Okay. Hmm. One ETF that could turn $100 per month into $500,000 with next to no effort. Where stock price is plunging now can be a smart time to buy. Mm. Growth ETFs can set you up for above average returns over time. However, there are risks to consider too. The right investment can supercharge your savings. Investing in the stock market isn't always easy, but it's especially challenging during periods of volatility. Stock prices have plummeted over the past year, and it can be tough to differentiate the good investments from the bad in times like these. But if you invest in the right places, you could potentially see lucrative returns when the market inevitably recovers. Can be a fantastic option to limit your risk while still maximizing your returns. And there's one ETF in particular that could help you build a portfolio worth hundreds of thousands of dollars with next to no effort. The Vanguard Growth ETF. How a growth ETF could maximize your earnings. A growth ETF is a fund that only includes stocks with the potential for above average earnings. These companies are more likely to experience rapid growth, which also means they have a better chance of beating the market. The Vanguard Growth ETF contains 247 stocks from multiple industries, primarily the technology and consumer discretionary sectors. A few of the largest holdings of the fund include Apple, Microsoft, and Amazon. In other words, by investing in this ETF, you will have a stake in all these stocks. The biggest advantage of growth ETF is the potential to see higher than average returns. Since its inception in 2004, the Vanguard Growth ETF has earned returns of over 341%, compared to the S&P 500 248%. That may not seem like much of a difference on the surface. Hmm. But if you had invested $10,000 in the ETF, you've had more than $44,000 today, compared to just under $35,000 with the S&P 500. Over decades, those hard returns can add up substantially. By investing consistently over decades, you could potentially earn hundreds or thousands of dollars or more with a growth ETF. Over the past 10 years, the Vanguard Growth ETF has earned an average annual return of around 12.8%. Keep in mind that the past decade has been lucrative for the market, but this ETF has also been hit hard over the last year. So your long-term returns could be higher or lower, depending on how the market fares. However, if you're earning average returns of around 12% per year, here's approximately how much you could earn over time by investing just $100 per month. To accumulate $500,000 in savings, you will need to invest consistently for roughly 35 years. Well, that's a long time away. Keep in mind that this ETF requires next to no effort on your part. ETFs in general are passive investments. You don't need to research individual stocks or make any difficult investing decisions. All you have to do is invest a little each month, then sit back and wait for your money to grow. Hmm. Okay, Vanguard the Growth ETF is one of the option I have if I want passive income. The good advantage of this is that I don't have to search or I don't have to analyze each company that I want to invest in uh, because it's like the mixture of companies. It's got a lot of companies in it, so I don't have to look at it one by one. Market Libre Bill. Okay, this is it for today. And I'm gonna see you tomorrow or the day after tomorrow. Okay, bye bye.